So, you have saved up your first $100 and you are thinking about investing it in the stock market. Maybe you have heard people say that investing is the key to building wealth, and now you are ready to take that first step. But then the questions start hitting you. Where should I put it? Will $100 even make a difference? Is it too risky? Should I wait until I have more money? Let me tell you something up front. Your first $100 is not about making you rich overnight. It is about building the habits, knowledge, and confidence that can grow into real wealth over time. That first small investment is often the most important because it sets the foundation for everything that comes after. In this video, I will break down exactly how you should invest your first $100 step by step. No complicated jargon, no risky bets, and no unrealistic promises. Just a clear, practical guide you can follow today. Start with fractional shares or low-cost ETFs. One of the biggest myths in investing is the idea that you need thousands of dollars to get started. This used to be true years ago, but now, thanks to fractional shares and exchange-traded funds, you can start investing with as little as a few dollars. Fractional shares allow you to buy a piece of a stock instead of the whole thing. For example, if one share of a company like Apple costs $200, you can still invest $10 or $20 and own a fraction of that share. This means you are not limited to cheap penny stocks, which are often risky and unstable. You can start with big, stable companies and let your investment grow over time. Another smart option is low-cost ETFs. These are funds that track a group of companies, like the S&P 500. Instead of betting on a single stock, you are spreading your money across hundreds of companies. This lowers your risk and gives you steady exposure to the market. Some ETFs even pay dividends, which means you can earn a little extra just for holding them. Think about this. Would you rather put your first $100 on a single risky stock or spread it across 100 of the world's biggest companies? The answer is pretty clear if you are thinking long-term. Choose a commission-free brokerage platform. Back in the day, every time you bought or sold a stock, you had to pay a fee to the broker. This made it almost impossible to invest small amounts because the fees would eat up your profits. But today, there are plenty of platforms that offer commission-free trading. Apps like Robinhood, Webull, or Fidelity allow you to buy and sell stocks with no fees. This means your entire $100 goes into your investment, not into the broker's pocket. Some of these platforms even offer fractional shares, making them a perfect choice for beginners. When choosing a brokerage, make sure you pick one with a simple interface, good customer support, and no hidden fees. You want something that makes investing feel easy, not something that leaves you confused or stressed. Your first experience with a brokerage app can make or break your confidence in investing. If you feel overwhelmed, you are less likely to stick with it. So, take a little time to find a platform that feels right for you. Focus on building the habit, not chasing quick profits. One of the biggest mistakes beginners make is treating investing like gambling. They put their $100 into some hot stock they saw on social media, hoping to double their money overnight. Sometimes they win, but most of the time they lose. And then they quit, thinking the stock market is a scam. The truth is, investing is not about getting rich quick. It is about building wealth slowly and steadily over time. Your first $100 should be seen as training money. It is about learning the process, getting comfortable with the ups and downs of the market, and building the habit of consistent investing. If you invest your first $100 wisely, you will see firsthand how powerful compound growth can be. Even if your money only grows by 7% a year, over time that small amount will turn into something much bigger. And more importantly, you will learn patience, discipline, and confidence, the real keys to success in investing. Think about this for a second. Almost every wealthy investor you admire started with a small amount and grew it over decades. Are you willing to play the long game like they did? Reinvest your earnings and add consistently so you have put your first $100 into a solid ETF or a few fractional shares of good companies. What comes next? This is where most beginners make a mistake. They stop. They watch their investment sit there, maybe make a few dollars, and then forget about it. If you really want to see your investment grow, you need to reinvest any earnings and keep adding money regularly. This is called compounding, and it is how small amounts turn into big wealth. When your investment earns dividends or grows in value, do not cash it out. Let it stay in the market and keep growing. Set a goal to add a little more each month, even if it is just $20 or $50. Over time, those small additions add up, and as your account grows, your returns grow too. That is the magic of compound interest. It works harder the longer you leave it alone. Imagine this: if you invest $100 and add $50 every month, in 5 years with average returns, you could have over $4,000. Not bad for something that started with a simple $100 investment. Are you seeing how small, steady actions can lead to big results? Educate yourself while you invest. Finally, the most powerful thing you can do when investing your first $100 is to make it a learning experience. The more you know about the stock market, the better decisions you will make. Start by reading beginner-friendly books like The Intelligent Investor by Benjamin Graham or watching videos from reliable financial educators. Follow the market news, but avoid getting caught up in hype or fear. Learn how to read basic financial statements, understand market trends, and study the companies you invest in. Knowledge is your greatest asset in the market. The more you understand, the less likely you are to panic when the market dips or get greedy when it rises. Instead of reacting emotionally, you will be able to make smart, informed decisions that grow your wealth over time. And here is something to consider. Every successful investor is a lifelong learner. Are you willing to invest in your knowledge the same way you invest in your money? Stay patient and avoid emotional decisions. One thing every beginner struggles with is patience. The moment you invest your first $100, you will probably start checking your account every single day, maybe even every hour. And when the market dips, which it always does, you will feel the urge to pull your money out to avoid losing more. On the flip side, when you see a small gain, you might want to cash out quickly and take the profit. Both of these are emotional decisions, and both can hurt your long-term success. The truth is, the market moves up and down all the time. What matters is the long-term trend, not the daily noise. If you can learn to stay calm during market swings and stick to your plan, you will be way ahead of most beginner investors. Remember, investing is not a sprint, it is a marathon. The money you make by staying patient for years will almost always beat the money you chase with quick reactions. So ask yourself, are you willing to be patient enough to let your money work for you, even when your emotions tell you otherwise? Your first $100 may not seem like much, but it is a symbol. It is proof that you are serious about your future. It is a commitment to yourself that you are ready to take control of your financial destiny. And if you stick with it, keep learning, and stay consistent, you will be amazed at how that small start can grow into something life-changing. Now, if you want to know the biggest investing mistakes beginners make, the ones that cost people thousands of dollars, make sure you check out my next video. I will break down the errors you need to avoid if you want to succeed in the stock market, because sometimes knowing what not to do is even more valuable than knowing what to do.